Like many homeowners today, I'm ready to move, but current interest rates make it impossible for me to afford a similar mortgage balance to the one that I already have. To put it simply, if I were to buy my own house again now, the monthly payments would be out of reach due to the significant rise in interest rates since I got my current loan. It's a common dilemma, but don't worry, I have some potential solutions to share, including the strategy that I'm planning on using to buy my next home. Here's my situation. I have a $500,000 mortgage balance left on my current home, and like many, I refinanced during the pandemic when rates were historically low. My 30-year fixed-rate mortgage is locked in at an incredible 2.25%. My current monthly mortgage payment is only $2,150. If I were to buy a new house with the same $500,000 loan amount at today's higher interest rate, my monthly payment would shoot up to $3,500. And that's a 63% increase. Over the 30-year life of the loan, I'd end up paying an additional $550,000 just in interest. It would definitely hurt to give up that rate because it's way less than the current rate of inflation. But my current house just isn't working for my family anymore. I know many of you are in a similar situation. Homeowners who would otherwise be moving are staying put, even if their homes no longer meet their needs. This is reflected in the extremely low inventory of homes for sale across the country, which is likely keeping home prices high because there isn't enough supply to meet the current demand. So let's dive into some creative solutions that help homeowners like us move into houses that better meet our needs. If you have an existing mortgage with a low interest rate, the first thing I'd recommend is asking your lender if your mortgage is portable. Most mortgages are not portable, but it's definitely worth checking because if it is portable, it could be the one thing that gets you into your next home. A portable mortgage allows you to transfer your existing mortgage, including its low interest rate and terms, from your current home to a new property when you move. This means you can keep your same mortgage deal even after buying a new house, instead of having to get a new mortgage at a higher interest rate. This can make moving much more affordable and save you a ton of interest. Another way I've found to afford your next home is by downsizing. Now, I know this won't apply to everyone, but some homeowners, like myself, don't actually need all the space they have. For instance, my house is 2,500 square feet, but we really only use about 1,500 square feet. So we could realistically move into a smaller house in a more desirable location that better meets our needs. And that's our plan. Because downsizing in square footage typically means downsizing in price. So as long as your desired neighborhood isn't significantly more expensive per square foot, this is a viable strategy for getting into a new home that you can comfortably afford. Our thinking is, if we don't need all our current space, then why pay for it? If downsizing isn't feasible or you need even more space, then you might have to consider moving to a lower cost area. This is quite common and it makes a lot of sense. It might be the only way to buy a house that meets your needs, especially if you have a growing family. However, there may be trade-offs to consider before moving to a cheaper area, such as a longer commute to work, lower quality schools for your kids, more crime, or other negative impacts to your lifestyle. Another great option that most homeowners tend to scoff at is renting instead of buying your next home. Believe it or not, in most parts of the country, the current cost of renting is significantly less than the cost of ownership. Many homeowners don't realize how expensive ownership can be when you factor in everything, including the mortgage, taxes, insurance, HOA dues, maintenance, and repairs. In cities like Austin, Texas, Seattle, Washington, or Los Angeles, California, renting can save you over $2,000 a month compared to buying. According to Realtor.com, the monthly cost of buying a home is 60.1% higher than renting. If you're worried about missing out on home value appreciation while you're renting, you can invest the money that you save by renting into another vehicle with a higher return, like an index fund that tracks the S&P 500 or NASDAQ 100. If it's feasible, you could also consider keeping your current home, but converting it into a rental property. If the numbers work out in your favor, your rental income could cover the rent on your new place, allowing you to still enjoy the appreciation on your rental property. If you love your current location, but you need more space or want to change the layout of your house, renovating your existing home is a great option. Selling a house is expensive. Between real estate agent commissions, repairs, cleaning, moving, transfer taxes, and other closing costs, you could lose up to 10% of the final purchase price. If you have a lot of equity in your current home, you might be able to leverage that to pay for remodeling. As long as you're happy with your location, renovating is usually more cost-effective than buying a new home due to all those transaction fees when selling. If you're considering the remodeling route, I suggest checking out my partner Realm. Realm is an amazing service that has simplified the home renovation process for thousands of homeowners, saving them an incredible 20 to 45% on remodeling costs. Realm pairs you with an expert advisor who will guide you through the entire process. They'll help you figure out what renovations you can actually do, considering local zoning and building codes, and use data from your area to estimate costs and show you which upgrades will have the best return on investment. They help you create your ideal design, and the best part is they ensure you get the best deal by negotiating with contractors for you. They also present different payment options to fund your project and stick with you until the renovation is complete and you're completely satisfied. I've arranged a special deal for you. Use my affiliate link below to sign up with Realm and you'll get $200 off your deposit when you start a project. It's a great way to save money while making your renovation dreams a reality. Anyway, let's move on to the next potential solution: buying a new house with an assumable mortgage. An assumable mortgage is a home loan that a buyer can take over from the seller, keeping the same loan terms, interest rate, and remaining balance. For example, if the seller has an assumable mortgage with a 3% interest rate, you as the buyer could take over their low monthly payments instead of getting a new mortgage at today's higher rates. Just remember that not all mortgages are assumable, so this option will limit your choices when it comes to selecting a new home. This next solution is easier said than done, but it's to increase your income and lower your monthly debts. It's just how lending works. The amount of house you can afford depends on your debt to income ratio, or DTI. If you can find a higher paying job or pay off that car loan, you'll lower your DTI and increase the amount of mortgage that you can afford. A pro tip is that a loan with only 6 to 10 months of payments remaining often doesn't count towards your DTI, so you may not have to completely pay off your debts in order to remove them from this calculation. The last option is to simply wait. No one says you have to do anything right now. You can always wait until you have more money saved up or hope that interest rates or home prices come down, though I wouldn't count on those last two things happening anytime soon. On the bright side, at least you already own a house. If you want to learn more about the costs and considerations of moving versus renovating your existing home, check out this next video. And if you want to see more real estate and investing content like this, make sure to subscribe.